I'm Josh Cohen. I run a venture capital fund called CityLight Capital, and today I am your moderator talking about sustainable cities. So why don't we start, because we have a little bit more time than we thought. So why don't we start with just general intros and how you wound up in the sustainable world?
You just want to disparage the Soros fund at all, or no?
Yeah, I read a tweet earlier that the Soros is ran out of money completely, and that's why.
Yeah, that's what it's funny. I heard that as well. Sorry.
They're wonderful people, and we appreciate them, and we love them, and we hope that Catherine has a speedy recovery. Why don't you start? So here's the deal.
Please.
Your professional background, how you wound up with your existing thesis, and then one fun fact that people can tell about you when they leave.
So my name is Eric Glass. I am the founder of an organization called Clarion, called Capital. I am an impact investor first and foremost, but I used to work for a traditional asset manager. AllianceBernstein is who I worked for, and I developed an impact strategy in public markets around fixed income investing, specifically in municipalities, with the explicit intent to reduce disparity in the built environment between those that have and those that have not. I think prior, sort of in terms of how I came to be in this ecosystem, if you will, a very, very long time ago, I ran a homeless shelter in East Orange, New Jersey for several years. And that was my first love. That was my first passion in terms of direct service provision to under-resourced, excluded communities. And I got some really bad advice from my mentors at the time who said, go to the for-profit world and do what you want to do. And from the moment I left the for-profit world, I was begging to get back to the nonprofit world. But through some long years in the desert, aimlessly walking around, I came across impact investing, this concept of triple bottom line returns. I kind of, I didn't split any atoms. I realized that where I was working, in the municipal finance world, when we think about education, K through 12, higher. When we think about access to clean water sanitation, we think about a transition from fossil fuels to renewables, we think about mass transportation, we think about housing, economic development, et cetera, et cetera. It's like it's the original impact market. And so I just sort of pivoted and said, hey guys, I think this is a good idea. They all laughed. We had a good time. They told me to go back to the corner. As most things happen, now this is my origin. You wanted an origin story? I'm giving you an origin story.
I like it.
Just so happens, and this is my thought on corporate America writ large, that nothing ever really happens because it's a good idea. Things happen, things change because someone lost money or lost the opportunity to make money. Back in 2015, we had a client, a legacy client at Bernstein Private Wealth Management, who left supposedly because they wanted to do impact investing. We didn't have that on our platform. And all of a sudden I became the new kid in town in an Eagles kind of way. And I'm dating myself. So with older people who know who the Eagles are, that's great. Give yourself a round of applause. Otherwise, and basically 4 years from idea generation to implementation, we raised and deployed $1.5 billion. I think what is most important for me, though, not to belabor the point, is the activism and advocacy that goes along with being an impact investor. It's one thing to make an investment. It's also another thing to use the influence, the leverage that you might have as being in finance with money. The hand that rocks the cradle is the hand that rules the world. I don't like it, but that's the way it sort of works right now. And if you as an investor can partner with grassroots organizations, grassroots communities, and to bring about change, the change that the community wants to see. There are very, very strong synergistic relationships that can move the needle for communities. And that's kind of what I do and what I try to specialize in. And with that, I will stop. I mean, in terms of a neat little fact, I think the fact of I'm going to stick with the homeless shelter.
I think it's a neat fact that AllianceBernstein recruits at homeless shelters.
Trust me, they do not. They do not. Let me just say that they do not. I'll leave it at that. Oh, and but what I will say though is I have the I don't know if I'm sure most of you are familiar with Jonathan Rose companies. I am a huge super fan of Jonathan Rose companies. If anyone has an opportunity to delve into what they do in a deeper way around housing, they are just a phenomenal. I'm fanboying here, so I apologize. But an absolutely remarkable individual and absolutely remarkable corporation, and one that we should also sort of strive to follow.
Well, thank you. Can you guys hear me? Okay, great.
You stole my job, you realize.
Yeah, no, it's fine. It's okay. He's trying to put you up, John. Well, thanks to 17 Asset Management for putting this together and for Reed Smith for hosting. It's great to be with you all and to take on topics like this that are so pertinent. Nathan Taft, I'm the Chief Investment Officer at Jonathan Rose Companies, and I've been with the company for 19 years and have helped our founder, Jonathan Rose, to really build out an investment management business. I mean, today we're one of the leading impact managers in the affordable housing space in the United States, and taking on what is really a crisis that confronts most cities and municipalities around the US. And so even in sort of these economic times, and even as cities are struggling, losing retail, losing hotels, and losing jobs, housing prices are still remaining high, and you've seen just amazing sort of rent growth numbers and putting a lot of pressure on renters, but then also interestingly or paradoxically, high home prices as well. So just pricing a lot of people out of the home buying market, especially as interest rates are now, headed towards 7%. So, anyway, so we are an investor developer. We really started as a company. Jonathan's a third generation real estate developer, grew up in a family business that does luxury high-rise residential, and one of the really preeminent owners of that kind of product here in New York City. But he had a different vision, and it was to build a business that integrated some things that he was seeing around sort of social impact in the environment, and felt that he could actually, rather than doing philanthropy on the side, the way his family had, is that he could integrate it into the business model and say, this is really going to be a risk mitigant. And so that's been something that we've really tried to work hard through our career to prove the case. And I think we've gotten there in a lot of respects. I mean, the way I got into this work was I started in a nonprofit space, also working in community economic development cities. I did the first year when President Clinton did AmeriCorps, where we were volunteering. My mom had this desperate hope that I was going to be a doctor. So I was working at basically an old broken down shelter in North Philadelphia to do an immunization program that the federal government wanted to roll out. It was a spectacular failure because there was so much mistrust in the communities. But what I got a firsthand view of was how our urban infrastructure in our cities were crumbling, and how you could do a short drive from sort of the place where my parents lived to where I was working and be in a completely different place where the air felt different, where just everything felt different. And so for me, I've been dedicating kind of my life and the work that I do to cities and reinvigorating them. And that's why when I learned about Jonathan Rose Company, I was like, this is amazing. Having a company that's focused on repairing the fabrics of communities, leveraging the capital markets to try to do that, and weaving in not only social impact, but also the environment is a really key element. So this is a place where, it's nice when you find a job where your life and the things that you care about sort of bleed into the work that you do every day. And so that's a great place to be. I guess fun fact is that I lived in mainland China for 2 years and was on a talk show there. Lord knows what I actually said, because I think my tones are still terrible. And then I guess the other 5th grade fun history fact is that I'm actually the great grandson of President William Howard Taft. So.
Who once got stuck in a bathtub.
Yes,
But you have never been stuck in a bathtub.
Not lately.
So is your mom okay with your career choice now? Yeah,
she's definitely forgiven me, but I think last thing, sorry to tell you about my childhood, but I think to the shelters, I mean, I credit her with where I am today, because I think she was constantly taking us to volunteer when we were young kids in transitional shelters for homeless, especially for homeless families. And so that also gave me sort of front row seat to geez, I've got it really good. And so I think, again, credit her for that. And I think now that I've been able to show her that we're having an impact on people and that this is not just about money, then, she's okay with me. So
awesome. So two exciting folks that I'm excited to get to know, but just to level the playing field for the folks in the audience, Me?
You, yeah.
You want me? I didn't get picked.
Everybody, this is
I'm just a moderator.
this is Josh. This is Josh Cohen. Josh, why don't you tell us a little bit about yourself? Long time listener, first time caller, Josh Cohen. Go.
The sea was angry, my friends, like an old man trying to return soup at a deli. Fine, I'll do it. I'm Josh Cohen. By the way, that was a line from Seinfeld. And if none of you got that, none of you are native New Yorkers. I've been in the impact investing world also for 19 years. It's been a long time. I run a venture fund called CityLight Capital. We do early stage digital health, climate, and education. We use AI heavily in our processes. We've been building it out for the last 6 years. The net result of that is we look at about 150,000 companies a month. We track about 3 million companies in the US. And our seed fund will probably do to 150 to 200 investments over the next 4 years. Outside of my work at CityLight, I'm a co-founder of a few different organizations in the impact investing world. And so 10 years ago, I co-founded a nonprofit organization called The Impact, which is the largest collection of family offices in the world pursuing impact investing. We have members in 22 countries around the world. And then probably 5 or 6 years ago, co-founded something called Impact Capital Managers, which is the largest collection of asset managers in the US pursuing social impact. And we have about 120 members in that organization. And so I show up not only as a fan of the gentleman to my right, but also a participant in the organization. That being said, I'm just the moderator. And so remember that when it's time for Q&A. For the purposes of leveling the playing field, we're here talking about sustainable cities. We'll get into why they're so important and what you all are doing to further them. But let's just start with your collective perspectives on what does it mean to be a sustainable city so that everyone knows what we're talking about. So Nathan, you want to start?
Yeah, I really appreciated how we were parsing sustainability from resilience, because I think it's something that when I reflect on how I was brought up, Jonathan in his thinking, that he was always loath to use the word sustainable. I mean, because when you looked at sort of what our practices were and what we were doing, they weren't sustainable. And even when they were green or we were becoming more energy efficient, like it wasn't getting there. This sort of creation myth, continuing the narrative, but spin this out for you, is just that part of how I found the company was that somebody gave me a newsletter that he'd written about a Tibetan village, which was actually a model of sustainability, where they were really living in balance with the land for how they were eating, how they were building their shelter, and et cetera. And so that for him was sort of this archetype or this of what sustainability could be. So everything that we were doing was lesser than that. So I think that was for me, something that was early kind of imprinted on sort of who we were. But for us, our whole ethos is really about, I think, the Raj Chetty data that a lot of you are familiar with, right? That it is just that we have this land of opportunity purportedly, but we have now cities in our country where your zip code defines your sort of life outcomes. And so, if you're not familiar with it, it's just this study data showing that you literally can go 5 blocks in one direction and have people who have a shorter life expectancy earn less money and, have lower educational attainment, et cetera. It feels fundamentally unfair. So our approach to sustainable cities is just that we want to level that playing field by creating more affordable housing close to the centers of jobs and employment, access to transit, community serving retail, et cetera. One of the things you saw when we've had our sort of previous financial crises was there's a group called the Center for Neighborhood Technology, which has done some really interesting data visualization looking at kind of carbon emissions, but also how that overlapped with foreclosures. And it was really just interesting to see that there are these rings of foreclosures often around cities where we have another concept in the US called drive to qualify, where people who don't make a lot of money are pushed further and further away from these things. And so they're left commuting long distances. And so when gas goes over $4 or in California goes over $6, they're getting crushed by the combined housing and transit costs. And the people that live in our properties are literally making trade-offs between health and wellness and sort of food at the end of months. And so I think for us, it was a lot about, hey, cities can be more balanced. And you look at the way traditional European cities have grown up in a more sort of denser model with preserving the open land around them. There's an element of that we should look to emulate. And so for us, it's always been about walkability. It's always been about trying to locate projects closer to mass transit to just try to level that playing field on a social equity basis. Last thing I would say just on this, on the environmental bent and where that fits in is just that we found like there's you look at our housing stock in the US, and by and large, like Berkeley Labs has done a lot of great work on this, Lawrence Berkeley, saying that all of this is older stock traditionally that is energy inefficient. And so you have this combined issue where people are living in housing where their utility costs are high, and they're polluting. So you've got greenhouse gas emissions coming from transit, but also from the built environment. And so for us, being able to green those buildings, use healthier materials at the same time to improve indoor air quality was sort of this double bang of lowering utility costs, but also just creating healthier environments for people to live in. So for me, that was really got to the definition of sort of what a sustainable city looks like, is where people who work there and people who are providing essential work can be able to be closer to those jobs and not have to work so hard to get there. So I'll leave it there.
I guess I would just to put some more meat on those bones. I wholeheartedly agree with what you said. It is about disparity from my perspective in terms of sustainability. It is about reducing disparity. One, community sort of leaps out off the page for me as an illustrative example. So up in Boston, I don't necessarily know if anyone's from Boston or knows Boston, but I'm sure most of you know Boston. But there are two communities, Back Bay, Beacon Hill, and just about 3 or 4 miles away is Roxbury. There's a 30-year death gap, life expectancy gap between those two communities. Right, so Back Bay, Beacon Hill, a wealthier community. The average, I'm rounding here, but go with me, is about 90. And the life expectancy in Roxbury, Mattapan, Dorchester, that area is 60. As impact investors, as sustainable investors, as resilient investors, that should be abhorrent, and we should be working to change that. And that to me is sort of the reason why I do what I do, or try to do what I do. And sustainability to me is reducing that death gap, is empowering community first and foremost. I think.
And do we do that by getting some of the people in Beacon who are Red Sox fans to die earlier?
Yes, I have actually thought I've spent many a alone thought session on how to make old, wealthy, white people die quicker. Unfortunately, the way science is, no offense to any older, I'm one of those people. I'm one of those people. But unfortunately, that when I did sort of put that out into the ecosystem, I didn't really get a really rousing approval for that plan. So it's really trying to lift up other communities as opposed to bring the current ones down. I found that, I think that's I just think it's more inclusive. It's certainly more inclusive. Anyway, as far as sustainability is concerned, that to me, I think that the way finance has, as an actor writ large, has largely been extractive. Has been punitive, and that needs to change. And we need to have different voices, different perspectives at the table. And I look at myself as a vessel for bringing change to community through the money that I can manage and the projects that we can underwrite.
Muni bonds are typically not considered a sexy part of somebody's asset allocation.
Shut your mouth.
So I've heard, I don't know why, but it seems like there's an element of sex appeal that you're bringing to the category.
Please.
This is true. You're bringing sexy to muni bonds, I feel like.
So now either you've done some research or that's incredibly coincidental.
It's totally coincidental.
Okay. So back in,
as you can tell, I did not prepare for this.
No, it's very clear to me that you did not prepare for this at all. You're pulling it off. It's a good job. But no, actually back in 2019, I did a podcast for an organization called Impact Alpha. And the headline was bringing sexy back to munis. Truth be told, I am a big fan of Justin Timberlake, but we're digressing in a very big way. No, I actually, all kidding aside, I should probably take this more seriously than I am, but I'm having a ball. So thank you. But I think that the municipal market is a really unique place to do impact. Again, municipalities, cities, states, localities have direct proximity to people. I mean, it sounds obvious, but it's very true. I think we lose sight of it based on a lot of things, a lot of public policy that we implement. But yeah, no, I mean, I can joke about it a little bit. Like I've done some lecturing, believe it or not. I've done some lecturing at graduate schools, business schools across the country. And I often ask folks, you know, just to get a sense of the room, you know, how many of you want to do VC or, you know, private equity? And everyone's hands goes up. And then it's kind of like, well, what about public equity? And like maybe a couple of hands go down. Fixed income, half the hands go down. Muni finance, crickets. It's just absolute crickets.
Until they realize it's like 30 to 40% of people's portfolios. And then the numbers add up.
Exactly. But I just think it's an incredible opportunity to, again, for those people who want tax advantaged income in the United States, and to understand that their values and better to align their values with the way in which they invest. The municipal market is a perfect place to do it, to uplift those values in a asset class that has a 10-year cumulative default rate of 0.1%.
What prevented you from creating this strategy inside of AllianceBernstein?
I did.
And so why did you have to leave, or why did you want to leave?
Great question. It really came down to misalignment, values misalignment. So as an impact investor, I wanted to make very loud and clear statements around what we were uplifting and centering. And, you know, nothing against anybody who's in traditional asset management here or online. I don't think that you can have, this is my personal opinion. At this moment in time, I don't think, hopefully in the future it will change, but I don't think right now you can have an impact platform simultaneously within a traditional asset management firm. There are too many cross currents around profit and loss statements. And for the guys who are and I mean this sincerely, for the guys who are at the top, they've been doing the same thing over and over again for the last 50 years. They're 3 to 5 years outside of retirement. There's absolutely no incentive for them to change, period. And you have someone like myself come along and say, well, there's a new paradigm. There's a new sheriff. There's a potentially new sheriff in town. Like, yeah, go ahead, try it. We'll see what happens. So I lose those P&L. I lose those P&L fights every day of the week and twice on Sundays. And, you know, when someone, you know, I'm not going to go into details, but when you make a request of a firm, of a C-suite to make a certain statement or to sign a certain statement, and their response to me was, you know, none of our competitors are doing that, Eric. We're not going to do that. You lost me. Like there's no reason for me to continue to beat my head against this wall. And I don't mean any disrespect. Like I mean, like, you know, some of my best friends still work for AllianceBernstein. But I'm just saying, like, I'm saying that jokingly, but it's just like, you know, this is just the industry that we work in. That's just, you know, these are the table stakes. These are the rules of the game. I just have chosen to go in a slightly different direction.
Infrastructure that you were birthed into, or the product was birthed into, had enough complexity that you were subject to that. But you couldn't figure out like how to manage the incentive systems and the personalities and the different products. You haven't had the same biases thrown at you. You know, you and Jonathan decided what kind of business you want to build and constructed an organization, a philosophy designed to reflect that. And so what are some of those purposeful decisions you made in setting up the org that allowed you to be different than what Eric was subject to?
Yeah, it's interesting because I do feel so affordable housing, if you're not familiar, has typically been the province of not-for-profits, which typically have a mission and they really stick to their guns and they do it and they deliver. But it also had been the province of for-profit developers who really didn't have a mission and didn't have a soul. And these were focused more on sort of extractive models of owning multifamily housing that happened to be affordable, and they were getting as much cash out of it as they can, tenants be damned. And so for us, what we've tried to do as a firm is to flip that on its head and say, look, with a little more thought, to be thoughtful and rigorous, to sort of use your example, you can actually set up systems where you ask questions and just do the hard work and get great returns for your investors, but actually deliver a great service. And so that was part of the whole embedding green building and sustainability in our mission of trying to like drive better outcomes with the actual physical real estate. But then the other is that on the social impact side, it was a shocking idea, is actually, why don't we ask the residents what they need? Versus like coming with a prescriptive model saying we're going to shove services down your throat, because isn't it nice that like we're coming in to like help you and here's what we're giving you. We actually practice something called asset-based community development, which is you go to the communities, you do resident night meetings, you do surveys with residents, you find out what do they need. And then you work on building services. It's not that we're moreless, so that we don't have any tenants. I mean, we have a lot that's focused around the basics of safety and security, getting people online so they have digital access, financial health and well-being, things like that, that are principles. But literally, we work with seniors, we work with low-income families with children. So we need to go in and we ask them, what do you do? And so I think for us, it's trying to be conscientious. And I think that committee you referenced to me was a lot that was coming out of, I think for all of us, like what had been the upheaval of George Floyd, of COVID, of just sort of this entire sort of shutdown of what we knew as like normal, and reawakening and sort of coming out of that and being as conscientious as we could about what is the company that we're building. Because it's the truth of the US is that disproportionately low-income families and people that we're serving are people of color. And so we want to make sure that we have an organization that is reflective of the people that we're working with. And so that's what we've been trying to build, looking really honestly internally who we are, but also then looking at our pillars of sort of our external facing, how do we show up for our residents and what's their lived experience like? And we're definitely not perfect. I think it's hard because when we step into a project, often tenants have been mistreated for decades. And so there is a lot in terms of bridging that gap of trust that can be extremely difficult. But we work in, as I'd say, diligently as we can, to try to bridge those gaps. And certainly doing that on race is one of the key things.
So here's your softball. So if you didn't provide these services, you'd probably make higher margins and more money for your investors, right?
Well, it's interesting. So we're actually embarking on a 10-year study right now. We've been able to we created a separate nonprofit and raised some grant funding to do a longitudinal study to see how the social services that we're providing are actually helping the overall sort of financial outcomes at our properties. We're trying to move beyond counting how many pounds of food we're delivering to how many people show up at programs to what is happening with people relative to education, relative to health and wellness, relative to their job attainment and earning potential. And so we're in the process. We've partnered with Columbia School of Public Health, with Harvard and Dartmouth's Health Economics Group, and then Enterprise and NeighborWorks to put together this study so that we can look at that and try to figure out. Because one of the things that was interesting when I joined, Jonathan, it was, we were a small company. I think we were 8 people when I joined. Today we're over 400 people. But those early days when we were going to raise our first funds, people looked at us like, well, sure, you've been around, but you've never managed money before in a fund context. And you're talking to us about affordable housing and green building. It's like, not happening. So but by hook or by crook, we raised our first fund. And today, like, I'm hoping we're having our first closing on our 6th fund, and we'll be, everything going right, cracking $1 billion of equity that we've raised for this strategy and then over time. But I think the issue is we've fought the fight on green building and sustainability and showing that and I know I keep using that word, sorry, it's become a little bit of an epithet after our intro, but making our housing more energy efficient. We've proven the case, right? And people no longer ask me, well, what kind of premium on rents are you getting or whatever? Like, we can show people that we can save them money by investing in these things. What I can't make a financial case, like, shut the book on, is on the ROI on our social impact piece, but we're trying to prove that out. And that's what our study is going to help us do. So.
Awesome. So I don't know if anyone has noticed, but ESG has wound up in the news quite a bit lately. It's going to wind up as part of a presidential debate next year, which I think is exciting for all of us for many reasons. But for a muni bond guy, that's got to show up front and center. How do you think about the ESG backlash, and how does it affect your strategy or your fundraising prospects?
I generally don't like to talk about it because I don't want to give it air. I don't think it.
Should I ask a different question?
Oh, no, it's fine. No, I didn't mean that. It's a perfectly fine question. I just choose not to get into those debates. The simple fact of the matter is, I think that what we're trying to accomplish as impact investors, sustainable investors, like we're trying to mitigate risk and identify value. And there are various, different tactics of doing that. And ESG happens to be one of the, one of the ways in which we do that. And ultimately, it doesn't, from my perspective, it really doesn't matter if you are conservative or if you are liberal. It's about improving community. It's about being humane, far less cruel than it seems like our current environment is. And if we can, and if investors can make market returns, all the better. I just, it's kind of like a doom. It's like kind of doom spiraling. It'll play itself out over time. We see things that are happening in the environment from a climate perspective. Go ahead. You don't want to address this? Okay. Eventually, something's going to happen where people are going to start really paying attention to. Unfortunately, it's usually going to be something that's really bad. So I don't really like to talk about ESG as being, woke or not woke, or like in the news or not in the news. For me, it's about building just, sustainable communities, and that's it.
The best revenge is outperformance.
Hopefully.
Would love to give each of you the opportunity to kind of promote your own book. And so if you pick a deal that you're either evaluating or that you've done, which highlights your thesis and perspective around sustainable cities, I think that would be illustrative to the folks in the audience. So Nathan, why don't you start?
Sure, it's hard to pick one. I have a lot of
You can only pick one
that I love, but I can only pick one. So okay, he says I can pick two. I have two moderators.
One.
Just one. Okay. We are making an investment now in California, in the Bay Area, in a project that was purpose-built as market rate housing. And we're buying it from an institutional owner, manager, global asset manager. And what we are engineering is a public-private partnership with a Bay Area housing organization to be able to take this market rate property and take it affordable. And so California has this really powerful tool called the welfare tax exemption. And so we're going to voluntarily restrict the rents, and in so doing, be able to pro rata sort of to the units that we make affordable, abate our real estate taxes. And so this is not going to be like a revenue driver play. It's really an expense reduction play that was letting us be the people at the table to win the deal. And so I think that's a pretty exciting thing. We'll be greening the project, working on advancing decarbonization of the project as much as possible, but creating affordable housing where there was not previously affordable housing in an extremely high cost market. I mean, you have relatively tiny bungalows that surround the property. This is close to a medical center and a city college, but bungalows that are over $1 million, some that are getting near $2 million. And so this will be really essential housing for people. So excited. We are typically, though, investing in Capital A affordable housing. So we're buying project-based Section 8 low-income housing tax credit properties and preserving those, especially ones that are at risk. But we're really excited in the Bay Area where it can actually cost almost $1 million to generate a new unit of affordable housing in the Bay Area. So this is a really economic way. It's kind of a win-win for us to bring new units of affordable housing online in a cost-effective, market-driven way. So that's it.
One of the investments that I was most proud of was being part of Newark, New Jersey's efforts to eradicate lead service lines in the city. So most of us have probably heard about Flint, Michigan, and the issues around Flint and corrosion control. But what we don't really sort of understand is, for Rust Belt cities, for older cities, there's water. It comes through a large main in the middle of the street, and then in order to get to a house, in order to get into residences and households, there's a service line that runs from the main into the home. For older cities, a lot of those service lines were made of lead. And if not perfectly corrosion controlled, the water eats out at the lead in that service line. The lead leaches into the water and it's consumed by the people in the homes. And so there was obviously the huge issues, global issues, or global attention paid to Flint, but so many cities across the country suffer from higher, specifically children, higher levels of lead in their blood. Newark was one of those. Back in 2019, they basically made a decision that they were going to, doesn't matter if you want it or don't, you are having your lead service line removed. And so they issued bonds, the proceeds of which, actually Newark didn't issue the bonds. The Essex County Improvement Authority issued the bonds, and they were AA rated credit versus Newark, New Jersey, which was a Baa2 rated credit. So they got a lower cost of capital, but they raised the money and they went and I had identified, originally identified 18,000 lead service lines. And I was a anchor order on that deal. And ultimately, they replaced 23,000 lead service lines over the course of 3 years, which is absolutely unheard of. That is the beginning of the end of lead in the water in that community. That's transformational from a health perspective, from a economic development perspective. Again, lead is a neurotoxin, a horrific neurotoxin that literally steals IQ points and causes a lot of cognitive issues, disproportionately impacting children. I just, again, think it's abhorrent that any community in this country would be consuming water with lead, and it happens with quite a bit of prevalence when we think about Chicago, we think about Washington, D.C., Pittsburgh, Cleveland, et cetera, et cetera. And so that's one example, but that's not where it ends. The idea is to make that investment, and then it's to use that model to create a movement to eradicate all service lines, lead service lines throughout the country. And so that's kind of what we're kind of hoping to do at some point.
You need a CityLight deal.
Who invited John Morris? Just one. So in 2006, I funded a company which was transformative for the work that I do. It was a company called ShotSpotter, which is in the business of acoustic-based gunshot detection. So we literally put a series of network microphones in inner cities throughout the world that listen for the muzzle blast of a gun. The sensors hear that sound, triangulate, and we can dispatch an officer to the exact location where a gun was fired. Now, why that matters is less than 20% of gunshots are called in. People who live in inner cities are typically immune to the problem and don't want to be snitches in their own neighborhood. We hear them roughly 100% of the time. And so in areas where this technology has been deployed for over a year, gunshot-related crime is down on average 30%. It's a company we took public in 2017. So economically, it's been very successful as well. And it was part of the reason why we've become the most active mental health investor in the country today, because if you're serious about reducing gunshot-related crime, you can't just deal with what happens after you pull the trigger. You have to ask the question, why are people pulling the trigger in the first place? And that often comes back to a perceived lack of opportunities. And so that comes into our workforce and education thesis, and mental health instability, which affects our digital health thesis. And so it's been meaningful on a bunch of different levels. And so happy to talk about that or anything else. I'd like to do a little bit of a lightning round before they give us the hook. And so think about this as like you've got no more than 10 seconds to answer the question. Will you be raising money in the next 12 months?
Yes.
Yes.
You think you deploy more capital this year or in 2024?
2024.
I'm sorry.
More capital deployed in 23 or 24?
24.
22 or 24?
Also,
21 or 24? Sorry, answer the 22 or 24 first. I went too fast for my
24. 24.
21 or 24?
be active. I mean, we're raising a bigger fund, so it'd be equal.
In terms of 21 would probably be larger because I was with a much larger firm and now I'm a startup. So I would say.
Will AI be a net positive or net negative for your strategy over the next 5 years?
We have not been able to figure out an approach that's going to help us by leveraging AI yet.
Ditto.
So solve for X. I would be much more effective in my job if the market only had more X. What is X for you?
Cheap debt.
Higher disregard for the impossible.
We have a presidential election next year. Do you think the result of that election will be positive for your strategy or negative for your strategy?
What do I want to happen?
You're a voter.
Yeah. I'm hoping it's positive.
Absolutely positive.
And then finally, something I'd like to know from everybody I meet, how do you define success?
How do I define success? Getting up every morning and absolutely loving the conversations that I get to partake in with really interesting, diverse, well-rounded folks that
Yeah, I mean, I think for us, it's around obviously the end result of all the work is like the tenants that we serve. So I think it's, are they better off? But the engine for that, or the fuel for it, is the investor capital we're able to raise. And I think to date we've built a real cohort of people who are like-minded, who want great returns, but they also want impact. And so I think being able to continue to attract that kind of capital and that kind of value-add investor is success for us.
I know I said finally, but I've got one more. Would you raise your family in a city as constructed today?
I am raising my family in the city.
I am as well.
That makes three of us. So I'd be a bad moderator if I didn't allow you folks to ask questions. I don't know how much time we have, but, and I don't know if I'm allowed to do this, but being that I've got a microphone in front of me, I'm going to do it anyway. Heather, can I get your help in calling on people? Ever seen the movie Jerry Maguire?
Sorry, can you repeat the question?
See the movie Jerry Maguire? So there's a scene at the end of Jerry Maguire where the agent, who I wanted to be a sports agent in a different life, a guy named Dickie Fox, says, I love my life, I love my wife, and I wish you my kind of happiness. For me, my entire existence is about being a better dad and a better husband. That's how I keep score. $35,000 a month, sir.
Yeah, it really depends. I mean, we have projects that are in the East Bay, and the reality is we're serving people who are earning typically 80% of area median income and below, and so the rents really can vary. We also, though, are doing things where rents are subsidized, so people could be paying 30% of their income, and that the balance is being paid by a long-term revenue contract from the federal government. So the reality is somebody could be very poor and paying $300 as their contribution to the rent, and the balance is coming from those contracts. So affordable housing, though, varies in jurisdictions based on what those area median income levels are, because there's a federal standards around affordable housing really define things as being typically in that range of 60% of area median income and below. And people should be paying no more than 30% of their income. The problem is that I think today, like 20 million American families are paying about 50% of their income in rent. And so that's part of the crisis. I mean, California, there are some studies coming out of the Joint Center for Housing at Harvard that say that we, I think, need, somewhere between 7 and 10 million units of housing to be created. California, McKinsey did a study, I think, pointing to the fact we need almost 3 million units in California alone. So it's a huge problem. We don't build enough housing in the country to keep up. So.
Well, maybe we'll just turn the excess commercial space into housing.
Definitely, it's starting to happen for sure. So
seems like there are a bunch more. Did everybody hear that?
Hi, can you repeat the questions?
Sorry, from what I think I heard the question was, is there any benefit in terms of issuing sustainable bonds? Is there any pricing benefit to doing that in the municipal market? Is that fair? Right. Okay. So differentials in pricing and whatnot. I would say that it's really interesting in the municipal market. It's it's a very staid and sort of technically speaking, to your point earlier, not a very sexy market historically. But it is the Wild West as it relates to labeling of something that's sustainable or something that's green. Much of what goes on in the municipal market is self-labeling. So it's self-labeling social, self-labeling as green. And so that sort of needs to change. There needs to be some sort of standards around that. I'm not a big fan of, like, I call it whatever you want. You call it chartreuse, doesn't matter to me. As a portfolio manager, as an investor, it's up to me to do my due diligence as to what about this particular project is environmentally, socially beneficial, et cetera, et cetera. It's not just leaving it up to some sort of random label. As far as the pricing is concerned, generally speaking, that hasn't really been proven out. And so my experience has been there is no benefit to doing a green bond or a social bond from an issuer perspective. I would say that this is a sort of a supply demand issue, that the more sustainability and impact becomes a larger part of the market, and more assets fall under those rubrics, that you'll have more oversubscription for those deals that cater to sustainable investors. With that oversubscription comes lower cost of capital, so there will be a difference in pricing.
Hello there, Nathan. This question is for you. Are you open towards joint ventures with professional athletes? We have a presence in Augusta, Georgia, with Warrick Dunn, and Minnesota with Devin George, former Laker. And we're tying in Neon, that's very interested in doing preventative health. So we're hitting a lot of those various different buckets. And we have so it ties in the family office, private and public partnerships. Some players from the Dominican Republic, where there's a fund allocated from the pension fund that's interested in investing in the Dominican Republic, but there's not any funds that are pretty much interested. So if you're very interested in that, I think we can tie those buckets.
Yeah, no, that'd be great. Thank you. I mean, when we talk after, we definitely, joint ventures are important, especially with local operators, and BIPOC operators has been a real focus for us in the past couple of years. So definitely be great. Thank you.
Sorry. I'll go real quick. And it's really, for you, Eric, AllianceBernstein, Merrill Lynch, a lot of different groups out there. I think what you went through, the asset management industry is very, old school, like you said, and there's a new wave coming on. I think groups like AllianceBernstein and Neuberger Berman and stuff like that, they are making a difference. They're trying to. And I think, your decision is awesome. That's what you have to make. But I have a lot of young people I also work with at Columbia and NYU and different, master programs. And I'm saying for them, stick it out there, become smarter up here so you can help from the inside. So I think it's a balancing act. And I just wanted to put that perspective in place.
Oh, no, absolutely. And I'm not so smart up here. So that's another issue in terms of, but what I would say is that I am incredibly thankful and fortunate to have had an organization as large as AllianceBernstein to basically fund my startup. And so I ran a startup within a large organization, and it was great. I mean, it was absolutely phenomenal. To a large extent, the agency and autonomy that I had. I had a canvas that I could create that was truly a reflection of my values and the way in which I wanted to invest. So I'm incredibly thankful for that opportunity.
it's an extension of regarding affordable housing. So one thing I think you mentioned in the Bay Area, basically, a bungalow start $1 million, which is studio, let's say. And that's relative to the market East West Coast. But also there's a lot of innovation coming out from a startup. I'm an investor entrepreneur, by the way. One of the startups I'm actually involved right now, they can literally build studio with the key. A month and a half, 50 grand. Luxury studio, let me precise, luxury studio. So you have a key just more for 50 grand. So, but obviously there's a lot of infrastructure that's missing around. And this is totally, I'm going to call it blind spotted by the impact investor, because everybody going to municipality, blah, 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 blah. That's opaque. And we're doing the same mistake, but we need to come out of that and sustain a new thinking, new approach, which is again, the future is startup period. That's how the innovation, not the industrial era, which is again, I'm going to stop by here. What's your take on that?
I agree with you. I mean, I think the somebody said to me recently, it's like the building trades are, somebody could show up from the 1920s on a job site today and still know what to do. I mean, there's a lot that we do just because that's the way we've always done it. I think there's a lot of innovation happening. I mean, we've done projects where we've worked on modular construction, other things. But to be clear, with our fund strategy, we're investing in existing multifamily housing to preserve affordable housing, and whether it's taking a market rate project and making it affordable or preserving what we've got, because we're losing that stock pretty rapidly. We do, as a firm, we build new, innovative, affordable projects. We're doing 700 units that we're building at 112th and Park Avenue, doing it to passive house standards, so doing sort of related state of the art there. But what you're talking about is really fascinating. I mean, people are doing innovative stuff. I know in the Bay Area, Factory OS is turning out modular. The issue, though, again, is like getting the permitting regimes to be able to comply with something like that that's innovative to upend what has been traditional conventional wisdom. So anyway, interesting ideas for sure.
Part of what I took out of that question is that as a venture capitalist, I am the future. And when I tell my mother about how this panel went, I will make sure to quote you. So thank you very much. On that note, we are getting the hook.